Imagine walking onto a commercial dealer lot, right? You sign the paperwork for a $100,000 piece of heavy machinery with $0 out of pocket.
Right, absolutely zero down.
Yeah, zero down. And you actually finish the year with $15,000 more in your business checking account than if you hadn't bought the machine at all.
I mean, when you frame it like that, it honestly sounds like one of those late-night television scams.
It really does.
Yeah.
But the crazy thing is, because of this massive structural shift in the 2026 tax law, a staggering 82% of businesses are currently doing exactly that.
Which is, completely counterintuitive to how most of us are taught to handle money.
Right.
Like the traditional instinct, especially when sticker prices on commercial equipment are so inflated right now, is to just avoid taking on debt. You don't want to pay interest on top of an already sky-high purchase price.
Exactly.
But the mechanics of capital have just fundamentally changed this year.
And so that is our mission for today. Welcome to the deep dive, by the way. We've taken this massive stack of 2026 economic outlooks, lender underwriting reviews, and the latest tax legislation updates. And we're tailoring this deep dive specifically for you.
Because surviving this year requires understanding how capital is actually flowing. Not just wincing at the price tag.
Yeah, we're going to distill the underlying mechanics of this current market into a real, actionable strategy for your business. Because let's be real. The sheer volume of lending options out there right now.
Oh, it can be totally paralyzing.
Yeah.
For a business owner just trying to navigate this, it's overwhelming.
Absolutely. So before we even touch the data, when we're discussing how to compare lender options, you really need a tool to cut through the noise. If you're thinking about financing equipment this year, the smartest move is to check what you actually qualify for first. Business Loan.Directory lets you do that in under 2 minutes without a hard credit pull.
Which is huge.
It is essential to see what is actually available for your specific situation before you get lost in the weeds of these macroeconomic trends we're about to talk about.
And those macro trends, they're the foundation of everything happening right now.
Right.
Because to understand how to exploit the financing loopholes available this year, we really have to look at the economic physics driving those inflated sticker prices.
Which comes down to material costs, right?
Yeah, material costs and just massive supply chain bottlenecks. We're currently looking at tariffs on imported steel and aluminum hitting up to 50%.
Wow, wait, a 50% tariff? That is a massive penalty.
It really is.
And that's hitting the manufacturing floor before a single bolt is even tightened on a new machine.
Exactly. And it creates this sort of cascading effect down the entire supply chain. That raw material penalty has pushed the effective tariff rate for finished construction and commercial goods to a 40-year high.
A 40-year high? That's just wild.
We're looking at an effective premium of like 25 to 30% baked right into the cost of heavy machinery, manufacturing tools, and commercial vehicles.
So, okay, let's unpack this. If prices are jumping that much, locking in a fixed interest rate on a machine today is essentially, it's almost like a time machine for your purchasing power.
That's a great way to look at it.
Right, because you are freezing the 2026 price of the equipment, and you're paying it off with future dollars that are gradually worth less due to inflation.
Yes. Exactly.
All while avoiding that 25% material cost increase that will inevitably hit if you wait until next year to buy it.
And that is the exact calculation chief financial officers are making right now. The hesitation we saw a few years ago, that was driven by interest rate volatility.
Oh, sure. When rates were just all over the place.
Yeah. Business owners were terrified of signing a loan because rates were swinging wildly month to month. But if we connect this to the bigger picture, the current interest rate environment has really plateaued.
So it's stabilizing.
Stabilizing, yeah. Traditional banks are offering rates around 4 to 4.5% for their absolute top-tier zero-risk borrowers.
Okay, but what about for the average business operating in the trenches?
Well, the national average sits comfortably between 6.5 and 7.5%.
Right.
So while we are definitely no longer in the 0% interest anomaly of the past decade,
Right, those days are gone.
Long gone. But this plateau offers predictability, and predictability allows a business to forecast its debt service over the next 5 to 7 years with absolute confidence.
It's like running a business right now is like driving a heavy truck with one foot glued to the gas pedal.
Yeah.
Like skyrocketing material costs. But you finally have one hand getting a firm grip on the steering wheel because of these stabilized, predictable interest rates.
That's spot on. It really sets the stage for calculated capital investments rather than, panicked reactionary purchases.
Which brings us back to that unbelievable scenario I mentioned at the start of the deep dive.
The $100,000 purchase that leaves you cash positive.
Yeah, exactly. So we have these massive upfront equipment costs driven by tariffs, but stable borrowing rates. To make the math work, businesses have to offset those huge initial price tags.
Right.
And that leads us directly into the biggest legislative shift of the decade, which is the One Big Beautiful Bill Act, or the OBBA.
The OBBBA. It has fundamentally rewrote the calculus of buying versus leasing for 2026.
How so?
Well, it made two permanent structural changes for equipment-reliant businesses. First, it fully restored 100% bonus depreciation for eligible property placed in service after January 19, 2025.
Meaning you no longer have to spread the tax deduction of a new machine over its useful life of like 5 or 10 years. You just write off the entire purchase price immediately.
Immediately, yeah. And that's along with a massive expansion of the Section 179 deduction.
Sorry, the cap went up.
Way up.
Yeah.
For 2026, the deduction cap is now roughly $2.56 million, with a phase-out threshold starting at just over $4 million. And these are inflation-adjusted numbers, specifically targeting the operational scale of small and mid-sized enterprises.
Wait, I'm getting stuck on the math here. Let me run this specific example from our sources past you, just to make sure I have this right.
Go for it.
Let's say you buy $100,000 worth of equipment. Your business is doing well, so you're in a 35% tax bracket.
Okay.
Because of that 100% bonus depreciation under the OBBBA, you deduct the entire $100,000 from your taxable income in year one.
Yes.
Which means that reduces your actual tax bill by $35,000.
Right. The IRS is effectively handing you back $35,000 in uncollected taxes to subsidize your capital investment.
But you didn't pay $100,000 in cash. You financed the equipment with zero money down.
Zero down. Yep.
So your total loan payments for those first 12 months might only be, say, $20,000.
That's a realistic estimate.
So your tax savings of $35,000 outpaces your loan payments by $15,000. Isn't the government essentially paying businesses to over-leverage themselves? Like, why wouldn't every single business exploit this loophole to the maximum?
Well, because that massive tax write-off only matters if your business actually generates enough taxable profit to use it.
Ah, right.
A paper deduction is completely worthless if you don't owe taxes to begin with.
That makes sense.
But for profitable companies, yes, it is a profound structural advantage. It's designed specifically to stimulate the manufacturing and industrial sectors.
So what does this all mean for leasing then? Because if buying gets you this massive tax write-off and literally puts net positive cash in your pocket in year one, why would anyone ever lease?
You really have to look closely at the mechanics of different lease structures. With a capital lease, which lenders sometimes call a finance lease, the IRS still treats you as the owner of the asset.
Oh, interesting.
Yeah, so you get the accounting flexibility of a lease structure, perhaps lower monthly payments, but you still get to claim those massive Section 179 and bonus depreciation tax benefits.
Oh, so you kind of get the best of both worlds there.
Exactly. However, operating leases, which are often called true leases, remain a really vital part of the economy for businesses that don't have that massive tax burden.
Because they can't use the deduction anyway.
Right. If your business had a slow year and you don't owe $35,000 in taxes, you can't use the bonus depreciation. So in an operating lease, the leasing company retains the ownership.
And they take the tax break.
Yes. They take the tax break themselves, and then they pass that financial benefit down to you in the form of a heavily discounted monthly rental rate.
Okay, that makes perfect business sense. You trade a tax break you can't even use for a cheaper monthly overhead.
Operating leases are also critical for assets that depreciate faster than their physical lifespan.
Like tech stuff.
Exactly. Think about specialized AI servers or rapidly evolving robotics. You do not want to hold those assets on your balance sheet for 7 years.
Because they'll be obsolete in 2.
Right. So we're seeing this massive shift toward equipment as a service, or EAS. Businesses are actively trying to shift their ledgers from capital expenditures to operating expenditures.
So you just pay for the usage.
You pay for the usage, the uptime, or the physical output of the machine, and let the manufacturer worry about the depreciation and the eventual obsolescence.
You know, that transition from high-level tax theory to ground-level reality is where this gets really fascinating.
It really does.
Because a $200,000 equipment loan looks completely different on paper depending on what your business actually
Oh,
does.
entirely different.
Let's look at the financial physics of three entirely different industries from our source material.
Let's do it.
First scenario, a regional trucking company needing a new Class 8 tractor.
Yeah.
One of those massive 18-wheeler cabs.
Okay, so the trucking sector is in a very precarious position right now. Our sources actually describe it as a cautious rebound.
Cautious rebound.
Yeah. The spot rates, which is a current market price a trucker can charge to haul a load, those have been compressed for quite a while due to overcapacity.
So revenue per mile is incredibly tight.
Very tight. But simultaneously, you have these stringent new federal emission standards rolling out.
Oh, right.
Fleet operators are being legally forced to upgrade to newer, cleaner engines, completely regardless of their current profit margins.
So the government is mandating the purchase, but the market isn't providing the revenue to comfortably pay for it.
Exactly. Which makes lenders incredibly nervous. A commercial truck depreciates rapidly based on the heavy mileage it accrues.
Sure.
Because the underlying value of that asset drops so fast and the borrower operates in a low-margin environment, lenders demand tighter residual value checks.
So they're going to charge more?
They will likely charge a higher interest rate on that 200 grand loan simply to offset the risk that the truck might be worth less than the loan balance in 3 years.
Wow. Okay, now contrast that underlying logic with our second scenario.
Yeah.
Let's talk about a commercial construction firm buying a $200,000 heavy excavator.
It is a completely different risk profile. The construction sector is currently experiencing a historic boom driven by two massive forces.
Federal infrastructure spending.
Yes, and an unprecedented wave of AI data center construction.
Oh, the data centers.
Yeah, data centers require massive amounts of land clearing, trenching for power grids, and foundation work.
So the contractors just have a multi-year backlog of guaranteed work.
Pretty much. And the asset itself, heavy yellow iron like excavators, bulldozers, and cranes, it holds its resale value remarkably well.
Right.
From a bank's perspective, this is fantastic collateral. If the contractor defaults, the bank can just repossess that excavator and sell it to another booming construction firm tomorrow.
So it's low risk for the bank.
Very low. Because the collateral is highly liquid and the industry is thriving, a $200,000 loan in this sector secures highly competitive terms. We're seeing median fixed rates hovering right around 7.38% at traditional banks.
Okay, third scenario. Let's look at a hospitality business. A restaurant owner needing a $200,000 loan for, say, a massive commercial kitchen build-out, industrial walk-in refrigerators, or outfitting a food truck fleet.
Restaurants operate on a rhythm entirely detached from construction or logistics. They face brutal, often seasonal cash flow crunches.
Right.
For a restaurant owner, fighting for the absolute lowest annual percentage rate is usually the wrong strategy.
Wait, really?
Yeah. Survival in hospitality comes down to cash flow management, which means flexible financing structures are paramount.
So for a restaurant, it sounds like the interest rate is almost an afterthought compared to the payment schedule.
Absolutely. Consider a coastal seafood restaurant that makes 80% of its annual profit between May and September. In January, their patio is closed and revenue falls off a cliff. A standard, rigid monthly loan payment could literally bankrupt them during the winter.
Oh, absolutely.
But specialized lenders offer skip month or seasonal payment plans.
Oh, that's clever.
The restaurant might pay a slightly higher APR overall, but the lender allows them to pay absolutely nothing during January and February. The interest rate is higher, but the survival rate of the business is infinitely better.
Seeing how wildly the rates, the terms, and the underlying lender logic swing depending on your specific industry, it really highlights why flying blind is dangerous.
It's incredibly risky.
You cannot just assume the 7% rate the construction firm secured is the rate the restaurant owner will get. Since rates and terms swing wildly depending on your industry and the specific asset, checking your baseline is vital. If you're thinking about financing equipment this year, the smartest move is to check what you actually qualify for first. Business Loan.Directory lets you do that in under 2 minutes without a hard credit pull. You need to see where your specific baseline is across different lender profiles before you commit.
It is basic intelligence gathering. You need to understand how the algorithmic models view your specific sector before you sit down to negotiate.
But, knowing what kind of loan structure you need is one thing. Actually surviving the underwriting process and getting the cash in your hand is another hurdle entirely.
Definitely.
Let's tear down the biggest roadblock keeping business owners from upgrading their equipment. And that is the pervasive myth. that you need flawless personal credit to secure commercial financing.
It is such a damaging myth because it forces businesses to limp along with broken, inefficient machinery out of fear of rejection.
Right.
The narrative that you need a pristine 750 FICO score to get a commercial loan is completely outdated.
Here's where it gets really interesting. Let me read the actual underwriting thresholds straight from our sources.
Yeah, please do.
Lenders like iBusiness Funding are accepting business credit scores as low as 400.
400.
400. And online fintech platforms like Credibly are consistently approving applicants with personal credit scores down to 500. It completely shatters the idea of rigid bank gatekeeping.
It really does. But we do have to examine why that traditional gatekeeping exists, though. I mean, why do massive traditional banks reject so many equipment loans, even when the business owner has decent credit?
What is the mechanism behind a traditional bank denial? I assume they demand years of spotless operational history and mountains of collateral.
They do, but the most common reason for a commercial loan denial in 2026 might actually surprise you.
What is it?
It is simply already too much debt. That specific reason accounts for 41% of all bank rejections right now.
Wow, 41%.
Yeah. Traditional banks use a metric called the Global Debt Service Coverage Ratio, or DSCR. Their algorithms look at your commercial mortgage, your existing business credit cards, your outstanding working capital lines, and they just lump it all into one massive pile.
So they just see a giant blob of liability.
Exactly.
They don't care that this new $50,000 pizza oven will allow the restaurant to increase its daily output by 30% and easily pay for itself.
No, their rigid algorithms rarely account for the specific, localized revenue that the new machine will generate.
That's so frustrating.
If your overall debt blob crosses their threshold, the computer automatically issues a denial, completely regardless of how much you desperately need that equipment to fulfill your pending orders.
So if you fall into that 41% of businesses rejected by the bank for existing debt, where do you turn? Because you still have orders to fulfill.
You pivot to alternative lenders and fintech platforms.
Mhm.
These institutions utilize a fundamentally different underwriting logic. They focus on the 3 C's: credit, cash flow, and collateral. And crucially, they analyze your cash flow using real-time API data.
Explain the mechanism there. What does API data actually mean for the borrower?
Well, instead of asking you to upload a static tax return from 2 years ago,
Which doesn't reflect your current situation at all.
right, a fintech lender uses an API and application programming interface to plug directly into your business checking accounts or your point-of-sale systems like Stripe or Square.
Oh, wow.
Their underwriting algorithm literally watches your daily credit card sales and vendor payments in real time. If your current daily cash flow proves you can afford the new equipment payment today, they approve you.
So they are looking at the living pulse of the business, not a historical autopsy.
Exactly, but there is a trade-off for that flexibility. Alternative lenders take on more risk, so they charge higher rates.
That makes sense. What kind of rates?
You might be looking at an 8 to 10% APR, or higher, depending on the asset and your cash flow health. However, because their algorithms operate in real time, they can fund a loan in 24 to 48 hours.
Unlike traditional banks.
Right. Traditional banks often take 4 to 6 weeks to process the paperwork and order appraisals.
Which raises an incredibly important question about how business owners value time.
Absolutely.
You have to consider the opportunity cost of waiting for cheap money. Imagine your main delivery truck breaks down. You can spend $5,000 replacing the transmission or buy a new truck.
Right.
If you go to a traditional bank for the lowest possible rate, your driver is sitting at home for a month while the bank processes the paperwork. How much money are you losing in unfulfilled contracts while that broken truck sits in the lot?
You could easily hemorrhage tens of thousands of dollars in lost revenue and permanently damage relationships with your core clients.
So signing a 10% interest rate with a fintech lender who funds your new truck tomorrow is vastly cheaper than securing a 5% rate from a bank a month from now.
Exactly. This raises an important question, right?
Yeah.
The interest rate is merely a cost of doing business, but halting your operations for weeks is a fatal disaster. It requires a paradigm shift for the business owner. You have to stop looking at the absolute cost of the money and start looking at financing as a tool to purchase immediate uptime.
So let's pull all of these threads together. Navigating the equipment market in 2026 requires balancing some really contradictory forces.
It really does.
You're weighing the reality of 50% raw material tariffs against a plateaued interest rate environment that finally allows you to forecast your long-term debt.
Right, and you are recognizing the incredible leverage provided by the OBBBA.
The tax bill.
Yeah, using 100% bonus depreciation allows profitable businesses to create immediate year-one cash flow, effectively using government tax subsidies to cover the initial cost of expansion.
And most importantly, you have to understand the specific financial physics of your own industry. Knowing how lenders view the depreciating nature of a commercial truck versus the liquid collateral of a construction excavator changes your entire negotiating posture.
Definitely.
Your real-time cash flow and your need for immediate uptime matter infinitely more than an arbitrary credit score.
The broader capital landscape has irreversibly shifted away from rigid legacy bank gatekeeping. We're now in an era of flexible, data-driven access to capital.
The tools are sitting right there. You just have to deploy them strategically. And part of that strategy is knowing exactly what your baseline options are before you expose yourself to a lender's sales pitch. If you're thinking about financing equipment this year, the smartest move is to check what you actually qualify for first. BusinessLoan.Directory lets you do that in under 2 minutes without a hard credit pull.
Operating without that baseline intelligence in a market this complex is an unnecessary risk.
Totally. As we look at where all of this capital movement is taking us, the trends point toward a massive psychological shift in how businesses relate to their physical tools.
Yeah, and I want to leave you with a final, broader thought to mull over regarding that.
Okay, let's hear.
We've discussed the rapid rise of equipment as a service models where you pay for the output rather than the machine itself.
Right.
We are accelerating into an era where businesses realize they are strictly paying for uptime. The physical machine is just a temporary vessel for the work you need completed.
It's like subscribing to your heavy machinery the same way you subscribe to cloud software.
Exactly. If this trend continues to capture market share, we have to ask a fundamental question about the future of business valuation. Will owning your own equipment outright soon be seen as a cumbersome financial liability rather than a core business asset?
Wow.
Think about that trucking company dealing with rising emission standards. Will they be better off leasing a truck by the mile, having it maintained by the manufacturer, and constantly upgrading to the newest tech?
Instead of owning it.
Right, rather than watching a depreciating hunk of metal slowly anchor their balance sheet down.
The transition from viewing ownership as a point of pride to viewing it as a stubborn liability that traps your capital. That entirely rewrites the roadmap for how an industrial business grows. We will leave you to chew on that one. Thanks for diving deep with us.